Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings so you don't have to. Today we're diving into the annual report of AGL Private Credit Income Fund. Don't let the fancy name fool you, there's always a story behind these documents. Whether it's a heroic rise or a slow and painful something else, we'll find it. This is their Form 10K, basically their yearly report card filled with information about their performance over the last year, what they did and what risks they're facing. It's our job to unpack it and see what's what. The company tells us that their goal is to make good money while not taking crazy risks. They want to do this mainly through income, so the company makes money right now, and a little bit through capital appreciation where the company makes more money later on as things get better. They're putting their money into loans that change with interest rates. That's typically quarterly, every 3 months. So when interest rates go up, they make more money, and when rates go down, they make less. They get income from the regular interest, from discounts when they buy the loans, and from fees that the companies pay them. Basically, they're trying to make money in a bunch of different ways from the loans they give out. They like companies that are bigger and more established. The upper middle market borrowers, figuring they're more stable. Now, how does the company make money? They charge a base management fee, which is 1.25% of the company's net assets. So the more the company has, the more the advisor makes. Then there's the incentive fee, broken into two parts. The first part is based on income, and the second is based on how well the investments do. Incentive fee, broken into two parts. The first part is based on income, and the second is based on how well the investments do, or capital gains. The income fee is where they try to take 12.5% of their earnings with some conditions. It seems this fund doesn't really want to sell, they want to keep it going, but after 4 years, if they aren't doing at least 5% repurchase of company stock or satisfying all requests to sell, whichever is slow, then they go into something called a reinvestment pause period, where they must return excess capital and can't reinvest loan repayment proceeds. This continues until the fund can complete a quarter 5% purchase and all requests. If the company lists itself, they will no longer need to repurchase stock. The company also discusses the market opportunity, which is private credit for lending. Private credit means it's generally not high yield and not publicly traded. The goal here is that the private market is typically more flexible to allow for faster execution, certainty in closing prices, and confidentiality when acquiring it. They plan to use multiple means of acquiring capital, but the key is their partnership with Barclays, called the proprietary Barclays channel. Barclays has been top advisor for mergers and acquisitions for a while. Because of this, the company should have a good stream of potential companies. When it comes to constructing a portfolio of loans, the goal is that the portfolio performs the same way throughout different economic cycles by limiting the portfolio's exposure to economic changes. They measure portfolio risk from a list of 10 metrics, which helps to determine the quality and strength of the portfolio. Okay, let's get into the risk factors. I know the scary part, these reports list all the things that could go wrong and you should take them seriously. Obviously, there are global issues that exist, things like war or terrorism, that can drastically change markets. Here's a big one, the company is very dependent on the advisor, and they state this clearly. The advisor is the one finding deals, handling the money, and making everything work. If the advisor's people leave, things could go bad and fast. There's some language to the effect that there might be other funds that have overlapping goals with AGL, and this could lead to the advisor prioritizing other funds over this fund. If they don't qualify for tax breaks, the company is in trouble. There are a lot of things they need to keep in line to continue receiving tax breaks. If they don't pay enough money out to shareholders, or they are investing in the wrong assets, the company will start being double taxed, and its ability to give you returns will greatly diminish. Because they are newly created, investors don't have much history to rely on when determining the strength of their offering. In addition, it will take time to properly train their staff to operate effectively. The business needs to be comprehensive and diligent when it comes to reporting. Efforts to comply with Section 404 of the Sarbanes-Oxley Act can involve significant expenditures, and non-compliance with Section 404 of the Sarbanes-Oxley Act may adversely affect us. We have to keep up with Regulation Best Interest. Regulation Best Interest enhances the existing standard of conduct for broker-dealers and natural persons who are associated persons of a broker-dealer when recommending to a retail customer any securities transaction or investment strategy involving securities to a retail customer. Since they need to align investment opportunities between them and the advisor's other affiliates, this can be tricky to manage. They need to get special permission from the SEC to co-invest with other AGL accounts. Because of this, some people might miss out on certain investments. There are many possibilities for tech issues. A failure in their computer systems could really mess things up. The company talks about using debt or preferred shares to finance stuff, and their asset coverage ratio has to stay above 150%. So if their assets lose value, they might have to sell investments just to keep that ratio in line, which isn't ideal. They acknowledge the inherent risks. They can be impacted by the interest rates, conflicts of interest with the advisor, availability of credit, currency fluctuations, and even armed conflicts in the world. The below table summarizes the portfolio and investment activity during the period from January 18, 2024, date of inception, to December 31, 2024. New investments purchased $474.5 million, which makes up most of their investments repaid totaled only $222 million, while unrealized appreciation came in at only $0.7 million. Can it seems a lot of their investment returns. In 2024, going to rely on new investment returns. In 2024, are going to rely on new investment returns. It seems a lot of their investment returns in 2024 are going to rely on new investment. They break down their business by where they are investing. The biggest allocations were in software and healthcare technology, which made up roughly half the company. Here's a view by industry composition at amortized cost and fair value as of December 31, 2024. 2001 2024. AGC bought dollars at $99 million for paper and forest products, while lower in amortized costs were valued higher than their original acquisition cost. This is excellent. Looking at the senior securities, two total now outstanding comes in at $391 million with asset coverage at 1,554 dirhams per unit. For expenses, they mention that regulation best interest might make it tougher for brokers to push the stock to retail investors. If brokers don't recommend this stock to retail investors, that might make it more difficult for them to bring in cash. Here in the expenses chart is the breakdown for fees, and what the company paid POV interest expenses was $3.9 million. Pro-organizational costs were $2.7 million, mean they were paid diners, which lead to net expenses for this period. January, December 2024 was $4.8 million. What all this means is that the company relies on third-party service providers for their work, but also that if the US declares that certain rights can't be held by the company, it could prevent the company from moving forward. Now, wrapping this up, what does all of this mean? Because this is a very high-risk, high-reward investment. If you're looking for a nice, stable stock, this probably isn't the one for you. They have huge reliance on their advisor to continue growing assets, but are restricted in their ability to do so in a multitude of ways. They're depending on a brand new Barclays partnership to source the bulk of deals. The numbers indicate a need to invest more in new investments as opposed to the strength of unrealized appreciation and current assets. So we can expect a big growth period as they use the capital on hand. That doesn't make this bad, but makes it incredibly sensitive to economic downturn, war, and a whole bunch of other things they list on their own. Basically, the fund has the potential for big gains, but could also come tumbling down like a house of cards. And that's AGL Private Credit Income Fund decoded. Hope you enjoyed that breakdown and found that helpful. Make sure to like and subscribe if you want more of this content.